Joining us for more analysis on this big story on central banks and rate cuts and stimulus from around the world is the Director of World Bank's Development Prospects Group, Hans Timmer, and economist Tara Sinclair, Assistant Professor at George Washington University. Thank you very much, both of you, to help us explain what's going on here. In a span of less than a couple hours, we saw all these announcements, and we were talking off air that, is it coordinated, is it not coordinated? But for investors, look at how they've reacted. It has been of concern, number one. Tara?
Well, I think that they're just reacting to the news that we've all been seeing for a long time now. We've talked a couple of times before about how the economy is looking like it's slowing on the global scale. And so it just so happened that these three central banks all responded in about the same time. But this was all anticipated moves, except for perhaps the China move, which was somewhat a surprise since they had just moved a month earlier. But we were still concerned about China's growth, and so it's not a huge surprise to see the central bank respond.
Hans, is there something that the central banks are seeing around the world that perhaps us, the media, or the public isn't seeing?
I'm not sure. I think these moves are indeed consistent with the slowing that we have seen since May, and that slowing has everything to do with the worsening in Europe, the increase in the financial turmoil. And you see that now reflected across the world in lower industrial production growth, lower trade growth, and then it's normal that central banks will ease. And it's not a lot more than that, I think.
Both of you follow the markets and as economists, and someone follows the markets quite closely, and you talk to experts in the field. Are the central banks doing the right thing? I mean, is this going to work? Because sometimes we debate the fact whether quantitative easing works, whether reducing interest rates actually stimulates the economy, or is there perhaps something more structural about the economy that needs to be fixed first?
I think these are relatively small impacts at this point. We're all looking at basically approaching the zero lower bound, as we've talked about here in the US, and now we're seeing that the ECB is going to unprecedented lows. So on that scale, maybe they can't do much more from the central bank perspective, but they're signaling that they're aware of the situation and they're doing what they can.
Is this it? I mean, is this their final shot across the bow for the central banks? Is there more they can do?
No, I think you have to realize that the problems in Europe and in general in the high-income countries are of a structural nature. We are now 4 years after the crisis. And there's only so much you can do with short-term policies, whether that is fiscal policies or whether that is monetary policies. And you have to take a longer-term view. In Europe, you need structural improvements in competitiveness in individual countries. You need strengthening of European institutions, and that takes time. And you see now periods of weaknesses, but they actually alternate with periods of relative strength. And we forget that at a moment like this. But the first quarter of this year was relatively strong. The last fall was weak. And now in May we have a weak period again. But actually when you look at the financial markets, then it's easing already again. So we are in for a long period of low growth in high-income countries. We have structural problems and we need structural solutions.
With a cut of interest rates, many suspect that perhaps that's to ease the flow of credit. It's always the assumption. Is there a problem with credit flow around the world, or is there not?
I think there is both a concern about supply and demand for credit, right? So the central banks are addressing the supply side of credit and trying to make it easier and more accessible, particularly to people who feel constrained. But there's also a concern that perhaps there's not that many firms out there wanting to borrow and produce new goods right now.
Well, man, that's a great point, because we know companies are rich. You look at Apple and Microsoft and all the biggest companies from around the world, they don't have credit problems. So who is having these credit problems that need money that apparently the credit isn't getting to them, Hans?
It's households who need credit, but I think more important is that it is an attempt to support the financial sector, which is struggling at the moment and which is helped a lot by lower interest rates from the central bank. I think in China there is a broader issue. It is not so much a panic reaction trying to prevent a sharp slowdown in the economy. It's a lot more. It's an opportunity to loosen and make more flexible the monetary policy at the moment.
One of the chief concerns whenever we talk about interest rate cuts or central bank moves is the fear of inflation, right? I mean, whether it's in China or India or anywhere else in the world. And you look at what the central banks have done, are we through worrying about inflation? It seems that way.
It looks like we are for right now. You look at what's going on, the Bank of England and the ECB both in particular referred to their inflation forecast going forward, and that was one of their justifications for lowering rates, was because they didn't see any great inflation on the horizon.
Yeah, in China, inflation is now 3%. Only a couple of months ago, it was 6%. So that was a signal for the central bank to loosen monetary policy. But there are other parts in the world, in emerging economies, where inflation is still high. Inflation is 10% in India. It is 10% in Turkey. It only came down a little bit in countries like Brazil. So our concern from the perspective of developing countries is not only that there is a lack of effective demand and you have to stimulate the economy, is actually that those very strong drivers of global growth, they have problems on the supply side.
Tara, Hans, thank you very much for your analysis on a very big day for central bank decisions. Thank you.